Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. Markets are back after a long holiday with lack of any major events yesterday. But let's recall the theme going into the weekend. Stronger dollar as stronger economic data from the US persists. Now, from the highs, we have seen some fall in the dollar, but whether this is just some profit taking or start of a new trend, time will tell. This week, we have got a lot of PMI numbers to focus on from Europe, UK, US, and even India. And we also have the Fed's FOMC minutes. Good morning, JK. Talk to us about what you think will drive markets this week.
Good morning, Swaraj. Yes, it's been quite day yesterday, of course, because both India and US were closed. But little backward, on Friday, we did have quite a few data of note and also statements from key members of the central bank. US PPI inflation rose 0.3% last month, the largest increase in since August 23. And in fact, it was down 0.1% in December. Ex-food and energy was 5 times higher than the 0.1 that was forecast. So we have had the PPI number, which is higher, following closely the CPI number also that came much higher last week. And these reports actually raise the risk of higher readings in the personal consumption expenditure price indices that will be published on 29th of February. On Friday, we also had the Michigan consumer sentiment, that is, which is something that is closely followed for the direction of the consumer expectations. And the survey shows that the reading was higher at 78.8, which is the highest level since July 2021. And also the consumers' views have been supported by confidence that inflation has turned a corner and strengthening income expectations as well. Outlook for inflation a year from now has declined 2.9% from 3.1% in December, following, that's the lowest reading since December 2020. We also had UK retail sales number that surged and by 3.4% in January after sliding 3.3% in December. But what this has given is some relief to UK economy watchers, because we had data previous day on GDP that showed the economy actually it went into a technical recession with Q4 contraction. So the increase was broad-based in retail sales and cheered by the market, but not much reaction in the currency, of course. Also, we had the Chinese central bank who cut their 5-year lending rate by 0.25% to 3.95%. This was more than earlier cuts in this tenor. But there has been disappointment that the long-term rates have been unchanged. Now, apart from the data that we saw, we also had a key member of the Fed, Mr. Bostic, saying that he expects 2 rate cuts in 2024, and that will start easing in late summer. Now, 2 cuts is where Fed seems to be moving towards after the recent data showing inflation getting stickier. And the first cut is not likely before June of this year. This is a big dial back from earlier March cut expectations, and even the full year easing is now expected at 89 basis points. Now, with with all these, the stocks, rather the bond yields have maintained their high levels after rallying strongly from January. As you can see, 10 years have moved by 52 basis points, and 2 year by 54 basis points from the lows that was seen in January. So the bond market seems to be awaiting the core PCE number later this month. Perhaps we will also look at the price component of these PMI numbers that will be published today, in this week rather. On the equities, they seem to be consolidating after strong gains of nearly 7% in the new year, awaiting more clues on the monetary policy and the economy. Of course, the geopolitical situation also is to be kept in the radar. On the currency, series of strong numbers on inflation, somewhat offset by retail sales, has seen dollar continue its ranged movement. It's been narrowing its band to less than 1% in the last 3 weeks. The revised expectation on rate cut prospects have not helped the dollar to move up. Actually, normally that's what we would have expected. So we are between 103.90 and 105 levels. A break of either can give some directional move. Individual currencies, Euro and GBP are in tight ranges. Yen is inching towards its previous double top high at 151.95. And we already seen some comments from Japanese officials on the one-sided movement. China returned after a long Lunar New Year holiday. Yuan is almost at the multi-week lows against the dollar, amid disappointment that authorities have not come out with any strong measures to lift the economy and the markets. Chinese markets rallied yesterday more than 1%, but today it is again subdued. And the technicals here are quite non-directional. For this week, as I said, we have PMI numbers from across regions. I'll be watching the leading indicator index of the conference board later in this week. And that number has been showing negative for several months, in fact. The conference board has been expecting US economy to be in a mild recession for Q2 and Q3. So that number will be very closely watched as well. And of course, Germany for the business sentiment survey, because Germany has been a laggard in the Euro region, and we'll see, look out for any signs of improvement after the recent data showing ZEW survey being better and also industrial orders that beat expectations. As for the local market, Indian currency has continued to be range bound, notwithstanding the two-way swings in the major currencies, and also the significant economic data from US and India, not really affecting it. We had trade data that came better in India, and the CPI number that was the other side, which could have ideally pushed the USD higher against the INR. But generally, USD INR has now stayed around 83 or slightly higher, all within the narrow band, despite strong inflows from corporates and also the FIIs, particularly for the bond market. This year in 2024, we have had as much as 5 billion inflow from the bonds, but they were offset quite a bit due to 3.5 billion of outflows for equities. An interesting point that I note is 1-year forward option on USD INR implied volatility has fallen to lows last seen in November 2006. Of course, the tightly held ranges for last several months and RBI's constant presence on both sides have led to the option premiums falling to such lows. So the current option interests are skewed, of course, slightly to the downside of the dollar, put prices being higher than the call prices. I will remain cautious and biased to a sudden rise in option premiums. But like the spot, we need a large macro trigger for the same. But right now, that is not appearing on the radar. But we will look out for any sudden news that can trigger a move in the spot US dollar overall as well as the USD. Thank you.
Thank you, JK. And quickly summarizing, we had some data on Friday as well as some speeches. US PPI inflation rose last month. It was higher. It was higher, followed by a higher CPI data. Now there seems to be some risk to the PCE, which is Fed's preferred gauge, coming in higher and pouring water over the rate cut bets. And what some of the Fed members are now estimating is that there will be only two rate cuts this year, and that cut is expected only somewhere in June. So there is a shift which is happening within the Fed itself. Now, Chinese central bank cut their 5-year lending rate by 25 basis to 3.90%. And on the domestic front, Indian currency has remained range bound. That's it from us today. Thanks for listening. Tune in tomorrow for the latest on the financial markets.